Hi everyone, I just very quickly wanted to go over our closing entries again. We talked about these in class today, but I made a minor error. I was going very fast because our tech wasn't working really all that well today. So I just very quickly wanted to cover before we get into practicing them wrong. So what we discussed in class and the amounts that we discussed in class, I wrote on the board behind me. So I just really quickly want to go through these so that we can look through them and do them correctly. So I talked about how we have permanent accounts, which permanent accounts are anything that is on your balance sheet. So any assets, any liabilities, and any owner's equity, we leave those accounts alone and we do not close them out. But at the end of every accounting cycles, we have to close in order revenues, expenses, the withdrawals, and the income summary after we've created that T account. So on the board, I put the T accounts, and as well as what I did this morning, I put them on the board just like I did. On revenues, of course, all revenues are normal credit balances of, well, normal credit balances. So I have 5,000 here. Expenses are AW, so they're always on the debit side. Their normal balance is a debit side. So I have a debit balance of 1,000. On withdrawals, they're part of AW as well, so they are always debits. Therefore, we have a debit of $500. An income summary just doesn't have a normal balance typically because it's not a normal account that we use anytime other than doing closing entries. So we start with the revenues, expenses, then withdrawals. So to do the journal entry, as I stated in class very clearly, what we're doing here is in order to close the account, we have to do the opposite of its normal balance. So in this case right here, revenues are normal credit balances. Therefore, we have to debit revenues in order to make this zero. So our journal entry is the date, of course, and the date for closing entries is always at the month end. So this case we were talking about March. So we do March 31st and we debit revenues in order to do the opposite to close it out. And the other part of that journal entry is income summary. For this amount, it was 5,000. And then we just put to close revenues. So we have a proper journal entry. We have a date, one debit, one credit, a reason why, and our debits and credits match. End of that journal entry. The second one is expenses. So again, I gave you a debit balance of 1,000. So if this has a debit balance, that means we have to credit it to close out that account and make it zero. Again, we're getting ready for the next cycle here. That's the whole purpose of closing entries. So we're going to credit here. So our expenses has to be the credit, and then we're just going to debit to the income summary account. That's the end of that journal entry. So here's where I made the mistake this morning, and I apologize. It was just going really fast. I wasn't thinking very much, so I want to make sure before we get into practicing them wrong, a withdraw is always a debit. So therefore, in order to close it, we have to credit withdraw, which I did right here, and that was perfectly correct. But this account does not go into the income summary account. This account goes into the capital account. So we make the withdraw, which has to be a credit to close out this account, but the capital account is the debit portion of that entry. Same information, everything else. The only thing that's different is that this doesn't go into the income summary. So the journal entry would be let's fix that, 331. Our withdrawal has to be credited. The debit has to be the capital account for the $500. Now we have that conundrum of figuring out what is our balance of our income summary. So here I've created a super temporary account called income summary. And up here, income summary, I credited $5,000. And in this journal entry, income summary, I debited $1,000. So $5,000 minus $1,000 gives us a credit balance in this account of $4,000. So the journal entry would be journal entry. the date 3/31, because it's always at the end of the month or at the end of the accounting cycle. Here it says income summary. We are crediting that $4,000 because we have a credit balance. So we are debiting income summary and crediting the capital account. So the first two, revenues and expenses, are dumped into the income summary. The last two are capital accounts. We never close the capital, but we're closing the withdrawals, which go into the capital account, and we're closing the income summary, which we've created to close out the revenues and the expenses. So that's how all 4 journal entries are done. Part of your homework 16 has you practicing the journal entries for the very first time. So I just wanted to cover that again because I did tell you that this went into the income summary earlier. I was just running along really quickly. It does not. It goes into the capital account. So again, all we're doing here is taking each account and doing the opposite of the balance that it has in there. So whatever I give you in the T accounts, if I give you a credit balance, debit it. If I give you a debit balance, credit it in order to close it out. And that is as difficult as journal entries are. If you have any questions, give me a shout out via email and I will answer as soon as possible. Thanks and have a great weekend, guys.